Hello everyone, welcome back for another video. In today's video, I'm going to be comparing two popular ETFs. The first ETF is SCHD. It is an ETF that I currently hold, the Schwab U.S. Dividend Equity ETF. And the other ETF is the JPMorgan Equity Premium Income ETF, or known as JEPI. And if you do enjoy content like this, please consider liking the video and subscribing for future updates. So first up is SCHD. The fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow U.S. Dividend 100 Index. And this is the Dow Jones U.S. Dividend 100 Index. The Dow Jones U.S. Dividend 100 Index is designed to measure the performance of high-yielding dividend stocks in the U.S. with a record of consistently paying dividends, selected for their fundamental strength relative to their peers based on financial ratios. Now, the fund screening metric is kind of complex. It does have several criteria. It must first pass each stock that's included in this ETF, must have a minimum of 10 consecutive years of dividend payments, and they also must be liquid stocks that are traded, and they also must be relatively large stocks. And then from there, it basically runs those stocks that met those criteria, or that meet those criteria, through this financial ratio, this equation here, and then filters out further, and then the goal is to pick the best of the best. So SCHD is based on that US 100 dividend index. So using those metrics, they select stocks, and these are the current top 10 holdings that the ETF holds as of March 31st. So all of these are quality companies, and they are all well established and have a history of paying dividends. And not only dividends, but appreciating dividends. So the ETF itself has a currently relatively high yield at 3.62%, and it also has a great 10-year dividend growth at 13.92%. So every year on average, the amount of dividends you receive increase about 14%. Now, looking at the SCHD dividend history on the NASDAQ website, you can see over time in this column here that the dividends increase year over year, quarter by quarter. Now, it varies by quarter because different companies are going to pay out at different frequencies. Some companies will pay out in February, some in March, and so on and so forth. So the amount of dividends that you receive on a quarterly basis will vary, but generally you do see an increasing dividend payment year over year, quarter to quarter. So it started paying out about 12 cents in 2011, and now it is currently at last December 70 cents. So overall, great dividend growth, and your yield on cost is probably phenomenal at that first purchase level had you have been buying this fund in 2011. And the fund has a very low expense ratio at about 0.06%. This is about in line with some of the lowest ETFs that are available. So you're not really going to beat that low expense ratio there. It doesn't really get much better than that. And Seeking Alpha actually has the updated top 10 holdings. So they did a rebalancing, and now their top 10 are a little bit different than what they were previously. You can see quality companies at the top like Broadcom, Verizon, and UPS. You also have Pepsi, Merrick, and Cisco. Overall, the fund is well diversified through various industries, and it currently has 104 holdings. So if you wanted it to be your only holding, you would be well diversified and know that you are investing in all quality companies that are well established and have a history of paying increasing dividends. And here is a back test of $10,000 since around 2012. It is comparing SCHD with the Vanguard S&P 500 ETF, better known as VOO. You can see that the S&P 500 ETF did outperform the Schwab U.S. Dividend Equity ETF by a decent sum over that time. However, the goal of SCHD is to provide dividends and appreciating dividends at that. So you're going to see that a common goal of dividend ETFs is to pay out these dividends, of course, which will limit capital appreciation over time. If you're comfortable with that, that's okay. Some people need higher current income than they do need capital appreciation. If you're not comfortable with that, then maybe SCHD is not for you. Maybe you should go with growth or just a regular ETF like VOO to invest in the overall market, possibly even VTI. So as simple as it gets, the ETF SCHD is a dividend-paying ETF that selects quality stocks based on several metrics that will pay you appreciating dividends over time. Now, JEPI is a little bit different. It has a relatively short history, being around only since 2020. And the fund has quite a higher average yield and quite a higher expense ratio. This is an actively managed fund, so you would expect that they would charge more for that active management. So let's get into why it has such a high yield. JEPI generates income from two sources. It generates income through a combination of selling options and investing in U.S. large cap stocks. So you get income from the companies that pay dividends that the fund holds, and then you also get incomes through the option strategy that it employs. And from that, the fund seeks to deliver a significant portion of the returns associated with the S&P 500 index with less volatility, in addition to monthly income. So what does the fund hold? The fund selects stocks that have low volatility relative to their peers, and they are selected from the S&P 500. So you have the top 10 holdings here, and you'll see that there is a bit of variance versus the S&P 500. Firstly, each of these stocks are weighted differently than the stocks in the S&P 500, and there are other stocks that you really wouldn't really see in the top holdings of the S&P 500. Things like Hershey's, Accenture, and Progressive. These are companies with low volatility, and that's why they are selected. Basically, the purpose of the fund is to provide low volatility income and try to track the performance of the S&P 500. So with this fund's dividend history, you will see that it is very different from SCHD. It is a higher yield, and it also varies quite a bit more. You see that dividends are almost paid in a random fashion, with some months having far higher dividends than other months. Now, the reason for this is that the fund is linked to covered calls, an option strategy. So as the market is more volatile, the premiums from these covered calls will be higher. So around this time in December of 2022, volatility was high, so you would expect a higher dividend payment. And now currently volatility is very low, so the payment that you receive went down. So the fund is great in that it will pay you higher in times of uncertainty. So when the market is full of fear, generally you will get paid a greater dividend. So this is a little nuanced, and it might be beyond the average investor or beyond the meaning of understanding, because the goal is income, and they say that they get income through selling covered calls on the S&P 500, but it is a little bit different than that. What they do is they have an equity-linked note that tracks an underlying index, and the underlying index is the S&P 500 with covered calls applied to them. So it probably more tracks the ELN, the S&P 500 buy-right strategy. Now, the fund doesn't actually invest in the S&P 500, so it's able to sell those covered calls on the S&P 500 through those equity-linked notes without holding the entire underlying. So again, it's a little bit nuanced, but they generate income basically from an equity-linked note, which is kind of like a debt obligation, and then that payment is based on the underlying asset, again, the S&P 500 buy-right strategy. So because of that portion in equity-linked notes, you do see this dividend variation here, which could be a plus or a minus depending on your goals. If you are expecting dividend income that is reliable and it's always the same, JEPI may not be the fund for you because it basically varies dependent on market volatility. Furthermore, although the fund is characterized as a low volatility fund, it is linked to the S&P 500, so the underlying does invest in quite a few equities. So what that means is in a declining market, the fund will still go down. As you see here, the height of the market was in around 2021 at the end, and it went down from there. Although not as much, it still did go down. So just because you're investing in this ETF, it doesn't mean that you are going to not see decreases. However, so far, the fund has performed about as well as expected. Here's a comparison of JEPI versus the Vanguard S&P 500 ETF, VU, just like from before SCHD. Now, again, the history is somewhat limited because the ETF has not been around for too long, but it performed over the time frame better than the S&P 500 ETF. A lower max drawdown, so it basically stated its purpose was to invest and have lower volatility, and you can see it had a much better worst year. So the fund does perform as expected. It has been having similar returns over time as the S&P 500 while having a lower max drawdown and a better worst year. And again, kind of illustrating the point of this fund, it again is linked to the market. So you will see kind of ups and downs, and this is with dividends reinvested. So if you don't reinvest your dividends, you may see different results. So as simple as it gets, JPMorgan Equity Premium Income, the fund JEPI, is an ETF that pays you income through a combination of dividends from its underlying stocks that it holds, and it also pays you income from a financial instrument that is linked to a covered call strategy on the S&P 500. So which of these funds is better between SCHD and JEPI? It really is based on your personal situation. So if you're the more classical dividend investor, SCHD may be better for you. It has a more understandable investment methodology, and it also pays consistent dividends quarter over quarter that are more reliable and less volatile. It also appreciates over time. So if you're young, holding this ETF for a long period may be more beneficial to you over time. And with JEPI, this ETF may be better for you if you are comfortable with the investment methodology, if you want a greater yield in volatile markets, or if you're just comfortable getting paid a varying yield month to month. And that is a difference between this ETF and SCHD2. This pays you every month, while SCHD only pays you every quarter. So if you are relying on income and you like that monthly payment and you use your dividends to pay bills, JPMorgan may be the ETF for you. JEPI, it has a more constant paying dividend, and it also pays you a higher yield. Now, either way, when it comes to dividend ETFs, both of these ETFs are pretty high quality. They have a pretty solid investment methodology, either of them, and they are both extremely popular ETFs that are traded with high volume. So whether you invest in one of the other completely depends on your personal goals and what your investment methodology is. Maybe you're older and need more income, or maybe you're younger and want dividend appreciation to work for you. So that is going to be it for today's video, everybody. I appreciate you all watching. Again, please consider liking and subscribing if you did enjoy this content. I will greatly appreciate it, and I will see you all in the next video. Have a great day.